David Lyon. First, let's talk about Silicon Valley, which is where you're from, and then we'll talk about the U.S. economy and the stock market at large. And it seems as though IPOs are doing fairly well this year. You have Twilio doing well, you have Acacia, so that should give the Bay Area a little bit of breathing room. They should be feeling better at this point in the year, don't you think?
Yeah, absolutely. I think there's been a huge sigh of relief with a number of these names going out in the past month and a half or two. You've seen a little bit of discount to pricing, but I think the biggest relief is the way they've traded after in the public markets. Well received, well priced, and I think the focus over the last 18 months of people growing at all costs and now focus on profitability with growth has made a huge shift and change in sentiment.
We certainly have heard less talk about unicorns. Are you hearing that in the coffee shops in San Francisco and Silicon Valley?
Yeah, there's definitely still 100 or 150 unicorns out there, or whatever the number is. But I think there's a little bit more skepticism and concern around kind of the bottom tier portion of those that have raised capital at really high valuations that'll never make it.
And what's the new thing out there? Is it cybersecurity? What's going on? What should people be looking for in 2017?
Yeah, I think probably three areas. Cyber, specifically for mobile. So mobile phone security has become a huge issue. Artificial intelligence, so the continuation of AI, and then robotics, so the merging of the artificial intelligence and robotics. Some fascinating projects that are going on right now.
All right, now let's get your stock market views. You like emerging markets and even developed international markets better than U.S. stocks. Why is that? Considering we're finally seeing a little bit of growth right here in the second half.
Yeah. Well, I think if you look back, this has been the longest period of outperformance of U.S. markets over the last kind of 7-8 years. So whether it's valuations, whether it's liquidity, when we look at the earnings potential, as you've had these currencies depreciate, the earnings potentials of these companies in emerging market countries and developed international look fantastic. So it's a reversion to the mean as well as a potential increase in earnings per share and growth on that front.
And when you are investing here in the U.S., you like the growthier segments of the economy. You like tech and retail. Is that just because you're from Silicon Valley and you're abandoning a lot of the defensive names, the utilities and the telecoms that got us this far this year?
There might be a little home-based bias, but I would say if you look at some of the defensive names, the search for yield that's gone on for the past 3, 4, 5 years, those valuations in utilities and REITs and some of the defensive names are sky high, 20 times multiples, 25 times multiples. When you look at some of these tech names, financials, energies, where you're getting single-digit PEs, I think the opportunity set there longer term is pretty attractive. And I think that's one of the biggest risks, is that unwinding of the search for yield trade.
All right, well, thanks a lot for coming on and talking about Silicon Valley.
Thank you very much.
And thank you for watching The Street.